All right. So don't forget that in our last class, we talked about the cost of equity, that is the minimum required return that investors are expecting from their investments, right? And we say that, oh, cost of equity is divided into two, which is the cost of equity. We say cost of capital is divided into two, rather. Cost of capital is divided into two, where we have the cost of equity as well as the cost of debt. Now, under the cost of equity, we're able to explain that, oh, the cost of equity, it is the cost to the firm because it is the sources of finance, right? While it is a return to the investor who invests in the company, right? And we look at the two methods of calculating the cost of equity, which is the dividend valuation method as well as the capital asset pricing model. Now, under the dividend valuation method, we said, oh, there are two methods of calculating what? The cost of equity under the dividend valuation method, right? Which is the dividend valuation without growth as well as what? With growth. I've explained this that when there is no growth in dividend, it means that this company will pay a constant dividend to perpetuity. Now the question is that do we have that kind of company in Nigeria, sir, today? Right? Now, if if company is not paying dividend, right? If company is not paying dividend, there should be something that will compensate the what investors, which is what the capital appreciation. Don't forget that investors' expectation are two. Either you go by is based on individual difference, right? I may decide to go for dividend, the other person may decide to go for capital appreciation. Capital appreciation means increase in what? Increase in dividend, increase in the share price growth. You buy shares at the rate of 5 naira today, and it's now increased to 10 naira, right? That is increase in the what? Share price growth. That is capital appreciation. Now, why I'm saying this is because I'm talking about dividend valuation method without growth. Now, individual differences may say, oh, let me invest in this company at the end of the financial year, or interim, I will receive an interim dividend, maybe first quarter or second quarter or last, just to send a signal to the what? To the investor. Don't forget that most companies, some companies will give second quarter, we pay interim dividend to their investors just to send a signal to them that, oh, we still have you guys in mind, and everything is still moving. As an aggressive investor, you will like, oh, let me quickly invest in this company because before the financial year, they will pay me dividend, right? So if there is no growth in dividend, right, that means you are using the what? Dividend without what? Without growth, which means that they will pay you constant dividend till what? Till perpetuity. Do we have such company in Nigeria? So I can't even wait till that kind of dividend. I will quickly switch to probably capital appreciation, whereby if I see that there is an increase in the share price, I'll quickly sell my what? My shares in that company. Now, if you don't want to use the dividend, how do we calculate the cost of equity using dividend without growth, right? It is calculated as K is equals to current dividend divided by the market value S div, right? I said it is market value S div. So why is it market value S div? It is because the dividend is yet to be paid. On the material that I sent, I said that, oh, if you have in a question, you have, if, you will catch up, don't worry. Abdurrahman will catch up. So if they pay, what is it called? What am I saying itself? Okay. The market value SDIV, right, means that the dividend is yet to be paid. The SDIV means that the dividend has been paid. When you see SDIV, it means that they've paid the dividend. It means that SDIV. So when you see in the question that say, oh, the dividend is yet to be paid, that is what? Cum div. You need to convert it to SDIV. On the material, it is being stated on how to convert the market value cum div to market value SDIV. Now we now move to dividend with growth, right? Now, if you want to calculate dividend with growth, it is calculated as KE equals to DO, which is D1, open bracket 1 plus G, which is the growth rate, divided by the market value S div, plus the growth rate, right? Now, in that formula, the growth rate will not be given in the formula, right? Will not be given in the question. You have to determine the growth rate. However, there are two methods of calculating what the growth rate. What are the two methods of calculating growth rate? We have what? The Gordon's, the extrapolation, as well as the Gordon's model. The extrapolation is talking about when there is a series of dividend. You have a series of dividend given in the question, and a formula is being attached to that as well, which is n minus 1 square root of the latest dividend divided by the current dividend divided by the base year, right? Which is the previous dividend. Okay, which is the previous dividend, right? Now, if that is established, so if that is established, I'm coming, and this is the current dividend under the extrapolation. You have the current dividend divided by the earliest dividend. I assume that you have already watched the video because I've explained all these things before. That is why I didn't move my cursor, right? Now, you have, what is it called? Under this, okay, that's fine. So, you can see that we have the current dividend divided by the earliest dividend minus 1. This is the extrapolation. This is how to determine the growth rate using what? Extrapolation, of which we have established this in our last class. Now, another method of calculating the cost of calculating growth rate is either extrapolation or Gordon growth model. And this Gordon growth model is originated from the profit, from the accounting profit given to you in the question, and it is calculated as what? G equals to R times B, where the R is the return on investment divided by the B. The B is the what? Is the growth rate. Now, and I said that the return on investment is calculated as what? Equals to profit after tax divided by the what? Divided by the capital employed, right? What make up of this capital employed, right? It could be net asset, it could be total asset, it could be what? Total equity. Depends on the examiner, how the examiner define the capital employed in the question. But if it is not defined, you can use any of the three, right? Either net asset, total asset, or equity. Now, we move to the B part of it. You know, the growth rate is calculated as R times B. Is that not so? Now, why the B is what? Retention, right? Which is retained earning. Don't forget, it is retained earning, retention ratio, right? It is calculated as the profit after tax minus dividend. You know, in accounting, profit after tax minus dividend, you have your retained earning, right? And you want to get the percentage. That is why you have to divide it by the profit after tax. We give you your retention ratio, right? So that is what you will use. You multiply R times what? R times B. Now, if this is established, we have the problems of Gordon's growth model. Don't forget that it makes use of accounting profit and it is actually subjective, right? Because accounting, it does not make use of cash flow. It makes use of accounting profit, and an accounting profit is what? Subjective. You can decide to use different method of depreciation. That is why it is what? The subjective. Now, let's quickly move on to the capital asset pricing model. Another method of calculating cost of equity now is capital asset pricing model. Don't forget that I said it's divided into two, the dividend valuation as well as the capital asset pricing model. Now, what is this capital asset pricing model? Capital asset pricing model is used to determine the minimum return on investment, minimum required return, minimum, what investors are expecting from their investment, right? Minimum, right? Investors are expecting either dividend or capital appreciation. Is that also why the what you calculate? It is the cost. The KE, which is the cost of equity, is a cost to the firm. It is a return to the equity holder, right? And it is calculated as RF, which is risk free, equals to equity beta, right? Market return minus RF, which is the risk free. Or if the risk premium is given in the question, it is calculated as RF plus beta and RE. It depends on what is being given in the question. I said that another name for risk-free asset is also known as treasury bill or government bond, right? It is that is one of the assumption, one of the limitation, as well as the limitation of capital asset pricing model. I mentioned that when we get to portfolio theory, we will explain more on capital asset pricing model, right? But now, let's just understand it this way. The risk-free, another name for risk-free is what? The treasury bill or government bond. So it could be, yeah, they may state it that, oh, it is treasury bill. So treasury bill means what? Risk-free, because it assumes that you will invest in a what? In a riskless what? Asset. It is not possible, because when you are talking about equity, don't forget that one of the characteristics between the equity holder and a debt holder is because an equity holder is taking risk to invest in a particular shares, right? Why is taking a risk to invest in a particular, why a debt holder, you must pay them their principal and interest. They are not taking any risk because there is an obligation, right? But an investor who buys shares is only expecting something from its investment. If anything come, fine. If anything did not come, fine. So that is one of the limitations, because the RF is what is risk free. Another thing is market return. Why we have beta factor. Beta factor measures systematic risk. I said this, when we get to portfolio theory, we will explain more on risk, right? On when we get to risk adjusted cost of capital, actually. Now, systematic risk I explained the other time is that are the risk that affect the general business, right? That affect the general economy, everybody. Talking about the inflation rate, the unemployment, the exchange rate, right? And so on and so forth, right? And we have here is what? The risk premium, right? And that is what we actually what explained in our last class. Distinguished professional colleagues, right? Are we still together, please? Are we still together? Let me quickly confirm that if we are still together.
Yes, we are together.
Yeah, we are together.
Okay, that's fine. That's fine. Is there any observation, any question? Any observation, any question before we continue, please? Any observation and any question? If there is, please quickly ask your question before we go to before we proceed with today's business, right?
By the time we start solving examples, we
It is
understand
not
it better.
my oga, it is not it is not to solve example that is the main problem. It's to understand the concept. So once you understand the concept, you can solve 100 questions on cost of capital. That is why I always take my time, right? Even the material, I always take my time to bring it out. These are the likely things I can will ask you. These are the things you need to know, right? I don't believe in that. I believe in understanding. So once you understand the theory part of it now, right? So when we start interpretation of, we start interpreting the question, you will understand it that, oh, IB mentioned that risk-free is treasury bill. I mentioned that. So this is what I want to hear, right? Don't worry, Abdurrahman, you will get it, right? There are a lot of, we have on the YouTube, you will see cost of capital part one and part two there, right? You can go there and watch the video. Now, in this case now, we now want to talk about the cost of debt. Now, class, what is cost of debt? Don't forget, we are under the cost of debt. We are under the what is it called? Under the cost of capital, right? Now, cost of debt, right? It's requiring that the borrower, right, to pay the lender, right, at the date of what? Maturity. It is an obligation that the company must pay back both the interest and the principal as and when due. Now, the cost, there is we have what? The borrower as well as the lender. Is that also? Now, we want to calculate the cost of debt to the borrower, which is the organization. Don't forget that there are all sources of finance. We want to calculate the costs to the what? To the firm. Why? Why when we get to bond valuation, right? My partner will take you on that, whereby you need to determine the return for the what? For the for the lender, not the borrower now. You know, you are calculating cost to the borrower, right? So when you get to book valuation, you need to calculate the return to the what? To the lender. We will get there. Now, you can see that the cost of debt now, you can see how it works. It is requiring the company or the organization to pay back the interest and principal to the what? To the lender as at the date of what? Maturity. It is an obligation. It is not what they are expecting. No, no, you must pay them back their interest and principal as at the date of what? As at the date of maturity. Is that also? Now, that is why the question may say that why is it that don't forget that the characteristics that I explained earlier, right, in our first lecture, is that the cost of equity is always higher than the cost of debt, right? The cost of equity is always higher than the cost of debt. Why? Because the equity holder take a risk to invest in a shares. Why? Cost of a debt holder, they are not the borrower, they are not taking a risk. They are not, because you must pay them back their principal and interest as and what? As and when due, right? Now, there are two types of debt class. There is traded debt and non-traded debt. Now, when I say traded debt means that our debt that can be traded as a what? As a debt instrument in a what? In the capital market, right? Right? Let me repeat this. Traded debt are debts that can be traded, is our debt instruments that can be traded in the what? In the capital markets. Now, it means that we can establish the market value of this because they can be traded, right? That is why it is called a traded debt class. Are we still together, please? Are we still together? So that is why it is called what? A traded what? Debt. Now, the next, under the traded debt, there is cost of irredeemable debt, cost of redeemable debt, cost of convertible, cost of preference shares, and cost of debenture or loan note. It can be used interchangeably in what? In a question. It could be loan note, it could be debenture. Now, class, we will now move to the first debt. Then we have the non-traded debt. Non-traded debt are debt that cannot be traded in the what? In the capital market. If a bank give you loan now, right, you cannot determine the market value of that loan, right? The only thing that they will do is that it is based on the interest rates, right? MPR. It is not based on the market value. You can't establish the market value of a bank loan. So that is why it is not traded in the what? In the what? In the market, because it is the government, it is government that decide. Okay, now look at what is the current MPR area now is about 26%, right? It's about 26 or 28%, right? The bank will be lending at the rate of 30% to 31% because they want to make a what? They want to make a gain on that particular what? Loan, right? And that is how it works. You cannot use it to determine the what? You cannot use Bank will not say, oh, what is the market value? No, they don't do that. They have to add their own percentage before they can be able, so that they can make what? Gain. Now, what is the cost of irredeemable debt under the what? Under the cost of debt. Now, who can explain what is cost of irredeemable debt, class? Irredeemable debt. Are we still on this call?
That
Yes, we
is
are with you.
cost of
Yes.
redeemable debt is the IRR, internal
Okay,
rate of
oh,
return.
according to you. Well done. Mr. Moses. Well done. Interesting. I like that. Now, now, the irredeemable debts are debts that cannot be redeemed, right? That is never repaid back. You see, in practice, irredeemable debt does not exist. But for purpose of examination, you assume that, oh, there is irredeemable debt are debt that cannot be redeemed, which means that it has a longer period. It could be 100 years, it could be 150 years, right? That is irredeemable debt, which means that you will continue to be paying both the principal and the interest, both the principal, and it does not have the date of maturity, class. And that is what? An irredeemable debt. Now, how do we determine the cost of irredeemable debt? Right? There is a formula for calculating the cost of what? The cost of what? The cost of irredeemable what? The cost of irredeemable debt. Now, the cost of irredeemable debt is equals to interest. Of course, you will pay interest. Are you not going to pay interest? You pay interest. This is debt. 1 minus tax rate. Now, definitely there will be a relief on the interest. The relevant tax authority will grant you a relief. There will be a tax relief on that interest divided by the what? the market value as interest. Now, let me start from the interest 1 minus tax rate class. The reason why cost of equity is usually higher is because of the tax relief, because the debt holder will get a tax relief on what? On the interest. That is why you will now have 1 minus tax rate. There will be a tax relief. Now, divided by the market value S interest. Market value S interest means that the dividend has been paid. That is, and sorry, what is it called? The interest element. The interest element has been paid. That is S interest, right? You will see it in the question. The question will tell you that, oh, the interest has been paid or the interest is yet to be paid, right? The interest has been paid or the interest is yet to be paid. So if the interest has been paid, that is the market value. They will say the market value, or it will even be stated that, oh, the market value of this and the interest is yet to be paid, right? Now, if the interest is yet to be paid, that is what we call cum interest. Cum interest. Now, if you have paid that interest, it becomes what? Market value S interest, which means that in a question, when you are given a question as cum interest, you need to find a way to get your words. You need to find, you need to look for a way to get the market value S interest. Class, you need to look for a way to get what? Market value S interest. A minute, sorry. Hello? Yeah, I did. Chai. No, no. Ah, hi, hi. I don't start class. Ha. Okay, no, no. Yeah, thank you. Mm. Sorry, please. Now, the KD, which is the cost of debt, the I is the annual interest payable, the T is the tax rate given in the question, then the market value, the market value, which is the MV, is the S interest market value of the debt. S interest means that the interest has been paid. If you are given cum interest, you need to convert that cum interest to S interest. That will show that, oh, you have paid this interest. So how will you convert your cum interest? How will you get your S interest? So market value S interest is calculated as the nominal value of the debt. Of course, we already know the nominal value of a debt. The nominal value of a debt, just like is the value being placed on a debt. It could be 100 or 1,000. They could say, oh, the nominal value of irredeemable debt is 100. The nominal value of irredeemable debt is 1,000. Fine. It depends on the examiner, right? Now, if the nominal value is 100, it will be the nominal value of the debt minus what? The interest rate given in the what? Given in the question, right? Minus the interest rate given in a question. So this will give us the what? The market value S interest. Let me repeat this. In every question, you are to divide it by the market value S interest. But if market value S interest is not given, and the question says that the interest is yet to be paid, that is market value cum interest class, cum interest. You need to convert it. You need to get your market value S interest. So now the question is, how will you get the market value S interest? Market value S interest is equals to the nominal value of a debt minus, you can see it here, minus the interest rate. The nominal value could be 100 or 1,000 class, and that is how to determine the cost of irredeemable debt. Class, do you have question? Class, question before we go to other debts. Question, are we good?
We are good to go. We can move to the next one, sir.
Yes, sir. We are good,
Okay,
sir.
okay, good afternoon, Damilola. Well done. So the next thing is to move ahead to cost of, see, we need to understand this. It is very important. So please, is what is very, very what important. Now, in this case now, we have the redeemable debt, right? Now, the question is, what is redeemable debt, right? Redeemable debt are debt that can be redeemed at a particular period of time. It's a debt that we paid at a specific period of time. There is a time for what? The maturity. For instance, you borrow 250 naira from me now. I will tell you that, Oga, this 250 naira that you borrow, you will pay me. You will pay it for 5 years. So, right? It has a specific date. It has a future date, right? That you will redeem it. You will collect. Redeemable means that I will collect my interest and principal in the next 5 years, and you must pay me. There's an obligation. It has a specific date, right? Abdurrahman, please put down your hands. Or do you have question? Now,
It's a mistake. Let's move on. It's a mistake.
okay. Now, the question is, how do you determine the cost of redeemable debt, class? The cost of redeemable debt, right, will be calculated using the internal rate of return. Look at it. The approach is to calculate the post-tax cost of debt. You've considered, we already know it's post-tax because because there will be a tax relief at the end of the day. We already know it's post-tax. Post-tax means that you take effect of tax, right? Now, post-tax cost of debt as the internal rate of return of the future cash flow, allowing for tax relief on the interest payment, yes, and the absence of the tax relief on the principal repayment using the market value as the cash flow at the time. Now, this story is telling you that when you want to determine the cost of redeemable debt, you have to use internal rate of return. The question is, when you want to use internal rate of return, what are the ingredients you will use in cooking that soup? You know, when you want to cook soup now, you need maggi, you need you need so many, you need fish, right? Now, what are the ingredients you will use in cooking that food, right? Now, for that food to make sense, right? What are the ingredients? What are the things you need to calculate the cost using what? Internal rate of return. First things you need to know is from your question, from your question, you have to look for the current market value of the bond. You have to look for the current market value of the bond, either of the redeemable debt. You have to look for the what? The current market value of it. This is the first thing you need to look for. Exclude any interest payment payable in the near future. First thing you need to do is that identify the current market value of the redeemable debt. Identify it. And that, if it is 1 naira or if it is 10 naira, it will be a cash outflow. It will be just like the normal way we do our investment appraisal, whereby your investment will be at year zero, right? So the current market value, the market value of that redeemable debt will be at year zero, right? Will be at what? Will be at year zero. Now, the next ingredient you need when you are to calculate the irredeemable debt is you need, of course, you will pay interest till perpetuity. You will pay interest, right? At till the date of, not perpetuity, you pay interest till the date of maturity, right? So the annual interest paid on the bond, right? It could be 7%, it could be 5%, right? Shown as a cash inflow for the numbers of years stated in the what? In the question. So it will be like an inflow, right? Don't forget that you already have the market value, just like your cost of investment. Then you still now have the annual interest payment. Of course, you will have to remove that from your investment as well. That okay, that makes it an inflow, right? Now, the next thing is you need the tax relief. What will be the tax rate? You need the tax. You have to reduce that interest. There will be a tax relief on that interest being paid because the relevant authority will grant you a tax relief on that particular what? Interest. So that is why if it is, for instance, class, if the interest is 5 naira and the tax rate is 30%, you have to charge 30% of 5 naira. That is the relief, right? So when you charge 30% of 30% of that 5 naira, what it will give you, it becomes an outflow that will reduce your what? Your interest payment. We will get there. I'm just explaining it how it works, right? We'll get we'll use a practical we'll do a practical illustration to that. Now, another thing you need is your redemption value. You know, we say it is redeemable debt. Now, your redemption value means that it's just like your principal. Class, when you borrow 50 naira from me today, and you are to be paying 10 naira every day, every day, every day, that is the interest. Now, you borrow 10 naira. Don't forget that you borrow 10 naira. Is that also? That 10 naira is the redemption value, right? Is the principal. Is that also? So, at the end of the date of maturity, when you are paying the interest, you need to as well pay back the what is it called? The redemption value, which is what? The principal. Now, this redemption, in a question, you'll be given that redemption value, the redemption is at par, right? They will tell you that it is redeemable at par, right? If in a question, class, in a question that says that it is redeemable at par, par means 100. Par means 100, which is often what? Par. Par means 100, right? Par means what? 100. It will be an inflow. Now, don't worry, we'll look at a practical illustration to that. Don't forget that I mentioned in our first class that, see, there is no room for excuse that you don't understand cost of capital. Do you know why? Because in this class now, we are doing a live class, right? If you check the YouTube, I have like cost of capital part 1 to part 8. Now, last diet, right? Some student needs to like send me private DM that I have done justice to the what? To cost of capital. So this one we are doing in class, it is an additional knowledge to you, right? It will be an additional knowledge to what? To you, right? So please, and that is how we roll. The redemption value, the redemption, if they say it is redeemable at par, par means 100. Olanike, do you have question for me? Olanike? Okay, now, I think it's a mistake.
It
Okay,
was a
exclusive.
mistake.
Okay, exclusive.
Okay, so well, please your screen. I can't I can't see it again. I don't know if it's from my
Uh,
end alone.
yeah, it could be your network. It could be your network. Please, others, please confirm if you can see my screen.
Yes, we
Yeah,
can
I
see.
can see your screen, sir.
Okay, okay, okay. Yeah, it's from your, I think it's your network. Okay, if these are the ingredients, how many ingredients you need? You need the market value, right? Market value as an outflow. You need the annual interest rate. Of course, you pay interest when you borrow money. Now, of course, your interest will reduce because of the tax relief. Relief means that you are supposed to pay me 10 naira. Because of the relief, you are now paying me 19 naira. Is that also? That is why it is an outflow, right? Then the redemption value is like a principal. What you will pay at the end of the period, both like your principal plus interest, right? And it can be at par. Par means 100. Par means 100. Par means 100. Class. Okay. Now, let's move on to, and that is how to determine the cost of redeemable debt.
Please,
Therefore, you look for the highest cost. You look for, I say highest cost. You look for Adiola.
please, sir, can you recap on the ingredients needed, sir,
Which one?
for redeemable debt?
Redeemable debt. Oh, uh, we'll do that one. Probably you watch it later. Now, I said that the redeemable debts are debts that can be redeemed at a specific period of time. It has a specific period, right? That, oh, this is the timeline. You will pay me 2 naira for 5 years. It's a redeemable debt. You pay me the interest and principal for 5 years. It is there. On a yearly basis, you'll be paying me interest, 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 interest. At the last year, you pay me the interest and principal, right? And that is all. Now, how do we determine the cost of redeemable debt? You use internal rate of return. Of course, when you want to cook soup, you need some ingredients, right? Now, what are the ingredients? What are the things you need to look for from your question? That is the current market value of the redeemable debt, the annual interest rate, right? As well as the tax on the interest. Of course, they will not give you tax relief. You have to charge it. If the interest is 5 naira and the tax is 30%, is that not so? It will be 30% of 5 naira. Is that not so? Now, that will be your outflow because there will be a relief. It will make your interest rates to reduce. We will get there, right? Now, the redemption is like your principal. At the end of the period, you pay both interest and principal. That your redemption value could be 100. Is always at par. Often at what? At par. Par means what? 100. Adiola.
I get that, sir. Thank you, sir.
So now, the next debt that we need to look at, that we need to discuss, which is the key. Moses.
Sorry, please. I have a question. Can the redemption be a discount? Is it
Thank you.
possible?
Thank you. That is a very good question. Thank you for taking us to that length. That is a very good question. Of course, I look at it that when we do a question, we will actually illustrate that. I think I actually omitted that part. That is a very good question, Moses. Well done. Now, let me quickly go back again. Now, the redemption could be at a discount, could be at premium class. All of us, we did business finance, at least in school to some extent, right? Now, if they say something, although when you get to bond valuation, your lecturer will explain more on that. Now, if a redemption is at discount, when you say something is at discount, it means that it is below the market price, right? Redemption, if the market value is like 100, for instance, and they said there will be a discount of 10% class. If they say the market value is 100 and they will do a 10% discount class, 10% of 100, you will be, let's say 10% of 100, 10 naira, it will not be 100 naira minus 10 naira. What do you have? You have 90 naira. Is that not so? That is the discount, which means that 90 naira is below the market value. It's below the market price, right? Class, let me come again. They say, oh, the market value is 100 naira class. We'll give you a discount of 10%. Say your discount will affect your market value so that your money will actually reduce. Is that not so? Now you say 10% of 100, let's say 10 naira, you will now have 100 naira minus 10 naira. What do you have, class? You have 90 naira. Class, is that not so? You have 19 naira. This 19 naira is offered at discount. Why? Because it is below the 100 naira. Now, when you offer something as premium, it means that it is above the market price. Take note, it is above the market price. Now, let's say for instance, the par value, it is par. Is that not so? The redemption is par, which is 100. And they tell you that you have to, the redemption value is at premium of 5%, for instance, of 5%. And the par is already 100, which we know. Now, which means that if it is premium, it means that it is 5% above the 100 naira. We will get there. There is a question that I purposely put it so that you will get that part. If it is premium is above the market price, right? We will get there. There is a question. That is the first question we will do in class together so that you will know that, oh, this is premium, oh, in case it is being stated in the question. Moses, thank you. Do you have any other person that want to ask question? I think I've explained that. Any other person? Class, are we good?
Yes, sir.
It's clear,
Okay.
sir.
Okay, that's fine. We'll
Yes, sir,
get
we are
there
good. We
actually.
are good.
Okay, thank you. Now, the next we need to look at the next cause of debt is the next cause of debt is the convertible debt, right? Class, what is convertible debt? This convertible debt is a bottleneck on its own. It gives students research so that students fail to understand the cost of convertible debt because it has some little calculations you need to do, right? Now, I think we'll end this class, right? We'll end this class because I have a flat battery now, and I don't think we can use that.